Hey, I'm Toni Taylor, Senior Loan Originator at Interconnect Mortgage in Palm Beach Gardens. Today, we're going to talk about closing costs in Florida, what they are, what every charge covers, who pays what, and how to keep that number as low as possible. If you're buying a home in South Florida and nobody has walked through this yet, you're in the right place. And if you have bought before, but it's been a while, Florida has some charges that catch even experienced buyers off guard. So let's get into this. Closing fees are the fees and expenses due on closing day, same day you sign the final paperwork and get the keys. In Florida, buyers typically pay between 2 and 5% of the purchase price. On a $400,000 home, that's $8,000 to $20,000. On a $600,000 home, you could be looking at $12,000 to $30,000. That is a wide range, and your exact number depends on your loan type, your lender, your county, and how the deal is structured. One thing to know from the start, your lender only controls lender fees. The title company, the county, the state, the appraiser, none of those costs are in your lender's hands. A good lender will estimate them accurately, but they cannot negotiate what they do not own. When you apply for a mortgage, your lender is required to give you a loan estimate within 3 business days. This document lays out every fee in black and white: lender charges, third-party costs, prepaids, escrows, all of it. I'm going to walk you through a real loan estimate right now so you can see exactly what each line means and what to look for when you're comparing lenders. Okay, I wanted to walk you through an actual loan estimate for a live transaction, and I'm going to walk you guys through this line by line. This is actually something that we do for every single transaction that we do, is provide you with a video explanation, but hopefully this is going to help you get some clarity about what you're looking at and understanding of how these fees stack up, what they mean, etc. So I'm going to walk you through this just like this was your loan estimate, and let you hopefully get an increased understanding of what these numbers come together like. So this particular loan estimate was done for a transaction that was written for an FHA mortgage. As you can see here, it gives the date that it was issued. Obviously, it verifies the loan term, and it does articulate that it is a purchase mortgage transaction and that it is a fixed interest rate. So here's your loan type, conventional. FHA is marked off. And this is important because this is telling you that this particular loan estimate, the interest rate is locked in and what the expiration date of that is, as well as the time of that expiration. Then here it gives you that sales price on this particular property for this transaction. So I'm going to walk you through this. You've got your loan amount of $328,932. You've got an interest rate on this particular deal of 5.75%. That gives a monthly principal and interest payment of $1,919.56. This verifies that there is no prepayment penalty on the loan and there is no balloon payment on the loan. It also confirms that for years 1 through 30, you have a principal and interest payment of $1,919.56. That is never going to change for the life of the loan if you pay this 1 month at a time for 30 years. It shows you your monthly mortgage insurance, which is $147, and it shows your escrow account. And the escrow account, just to clarify that is actually these for the property taxes and the homeowner's insurance only. Now, if you had flood insurance, then this might be marked off, and that would be for the flood coverage. So in this case, it's just property taxes and just homeowner's insurance. Now, you're going to show the total estimated monthly payment of $2,354, and then this is showing you the dollar amount of the mortgage insurance and the escrow amount. So it's not in addition to, this is your total monthly payment. This is just breaking out the taxes, the insurances, and the mortgage insurance premium as a lump sum there. So this number here, the $1,919.56, will never change as long as you have this loan. The mortgage insurance, because this is an FHA loan and it was done at a 96.5% loan to value, so the purchase price with a 3.5% down gives you your loan to value. Those two numbers will not change unless you refinance this mortgage. Okay, now conventional, that could potentially dip away once you hit an equity position, but for now that's going to stay static because this is FHA. Come down a little bit further, and what it's doing here is giving you the total estimated closing cost and then your estimated cash to close. Now we'll come down a little bit further and we're going to get into the nuts and bolts of where these numbers come from. So the first box, box A, this is where you're going to see your underwriting fees, your admin fees, any discount points, etc. This transaction had an origination fee, or discount points I should say, of 0.088% of the loan amount for a total of $289. So you could have an underwriting fee in here, you could have an admin fee in here. This is the box that is basically reflected based on whatever your lender's fees are, any junk fees that they have. And this is a section that's negotiable. Now, typically, the lower the interest rate, the higher your cost here can be. The higher your interest rate, the lower your cost here can be. So that's how that number gets pushed around, and those are determined based on many variables in your transaction. Now we're going to come down here to this section B, and you're going to see it's services you cannot shop for. So they are costs that you're going to have on your transaction, and the first one is your appraisal fee of $650. That is a line item that you're actually going to pay in advance directly to the appraisal company when the appraisal gets ordered before they complete the appraisal. Now that number can fluctuate a little bit depending on your actual type of your loan transaction. The good news is that nobody can charge you a penny more than the actual cost to the appraisal company to get that done. Then you have your credit report fee. We're showing $135. That is for your tri-merged credit bureau, whether you're one borrower or whether there are two of you on the transaction. And that is also paid for upfront. So the numbers, even though they've been paid, will continue to show on your documents until they go to closing. And then at closing, what happens is those numbers will move into what they call a POC column, or a paid outside of closing. Obviously, you're not going to pay for things twice. Now, like your appraisal, your credit report fee cannot exceed what the dollar amount is that the credit bureau themselves actually charged the reporting company that was used. Then you have your FHA upfront mortgage insurance financed into the loan. So FHA has not only monthly mortgage insurance, but it also has a upfront fee, and it is based on the actual transaction. So that amount actually gets financed in here. FHA dictates those numbers. Then we've got a flood certification fee. Now that dollar amount can fluctuate a little bit depending on who the lender is. Some of them have different arrangements where, we see this from anywhere from usually $15. This particular lender that we were placing this loan with, their charge was $5. Then you have a MERS registration fee of $24. Now that stands for Mortgage Electronic Registration. That is how the industry keeps track of your recorded documents and instruments on the backside of the transaction. Then there's a processing fee. This actually goes out to a third-party company in this situation, and that third-party company is charging $995. So like your appraisal fee, like your credit report fee, the mortgage company cannot profit on that as a mortgage broker. A lender can, but a broker cannot. So if the third party charges a higher dollar amount, your fee is going to be a higher dollar amount. If they charge a lower dollar amount, it's going to be a lower dollar amount. The mortgage company cannot profit on that. Then you have a verification of employment fee. So what that means is if we have to pay other parties, sometimes it's a technology company, sometimes it's actually third-party vendors that will supply the verification of employment, that fee gets passed on to you. This particular example, we're just doing a demonstration of $150. Again, like the other line items, it can never exceed the actual real cost. And if there is no fee to verify your employment, maybe you're self-employed, then that fee goes away altogether. Okay, come down a little bit further, it's services that they say you can shop for. So in this particular case, this is all title related items on this particular disclosure. They have a document prep fee of $60. The survey fee, which the survey is what verifies that nothing on your property is sitting outside of your actual boundaries. That surveyor is charging $450. Like the appraisal, like the credit bureau fee, they cannot make a profit on that, so that will be the actual invoiced number out to the survey company. Then the title search, we're estimating $250. The title lender's endorsement, $228. The lender's title insurance, $350, and the settlement and closing fee, $550. Now, these numbers are going to be dictated by the title company and by the survey company. So your lender has no say ultimately in what those numbers are. And as we mentioned before, Your seller may be picking the title company and paying for the owner's policy, but you will still have costs that are pushed over to your side of the transaction. I can tell that this particular transaction, the seller is paying the owner's title, because if they were not, then the owner's title line item would be in there as well for you. So now what you can see is, just to kind of give you an explanation here, you see you've got that line item here, it's just bulking for the entire section, the total there. Same thing is happening in section B. That's all of these items totaling that number. Come into section C, same thing. It's totaling it up here. Now they're adding A, B, C, and D for a total of $97.93. Now we're going to come over here to the right-hand side of the loan estimate. You have your recording fees, and again, same thing. It's got a category. It's going to lump them together. So this is the intangible tax on the mortgage note that the county charges, and these are the doc stamps on the mortgage that the county charges. Again, those are not in any control of your mortgage company. Those are dictated by the county that your property is located in. Then you have your prepaid. So prepaids are things, they're expenses that you would have no matter what, but they are paid in advance. So one of the first things that you're going to have is your homeowner's insurance is going to be paid for 1 month in advance on a purchase. So you're buying your home, you're closing today, you're buying an insurance policy that is covering your home for the next 12 months and will renew next year on your anniversary date. Then you have what we call in-term interest. So in-term interest, in this case, is $51.82 per day for 10 days. So what happens is, if you go to closing, for example, on February 20th, February's probably a bad example because we have 28 days in the month most years, but let's say we go into closing on the in March, and you close on March 21st. There are 10 days between March 21st and the 1st of April. So you would pay for those 10 days worth of interest at closing. Conversely, if you closed on the 5th of March, you would then pay 26 days, because there's 26 days between the day of closing. So the time of month that you close, the time of the, in the calendar, can affect this number up or down. Again, your lender has nothing to do with that. Same thing with the insurance. That's going to be dictated by the insurance companies. Then you have your actual escrow payment. So insurance, even though you've paid for a year in advance, you're still going to start building your escrow account, which is your savings account, so that next year when the renewal for your insurance comes due, your account will have sufficient funds in there to pay for that renewal. So in this case, the insurance, they're collecting 3 months on this particular document. Now on the property taxes, we're showing 5 months being collected. Now I want to be clear about something. This gets a little bit confusing, especially in different states, because it's done differently depending on municipalities and seasons and etc. What happens is, your seller is responsible for every day of the calendar year that they owned the home for their property taxes. You will need to put enough in your escrow account, so when the tax bill comes due, in Florida it's November, you will have accumulated enough money in that account that the mortgage company can pay that for you. So right now, because it's a February closing, they're collecting 5 months from you. You would actually get a credit back at the closing from the seller for the days of the month this year that they own the property. But this is the dollar amount that you're going to put into that escrow account. Now the good news is, the government many years ago put some rules in place that said, hey, we're not going to let the lenders stockpile or take excess amounts into escrow. So they do govern how much can actually be put into escrow, and if they deem that they've exceeded those thresholds from a government standpoint, then they do an adjustment on that escrow account, and those monies are reduced from the dollar amount that you come to closing. So this number, again, ultimately is not going to be dictated by the lender. It's going to be dictated by the amount of the annual premium for the insurance policy and for the amount of the annual property taxes on the property that you're acquiring. Come down here, you've got everything else added up together, so sections E, F, G, and H for a total of $59.03. Now you're totaling D and I together for a total of $15,696. So coming down a little bit further, the borrower's down payment is going to be, and this is basically when I say down payment when you're buying an FHA home, you're putting a 3.5% down payment. So their total is going to come in, and you're going to take into consideration any dollar amount that they've already given. So they've already given $1,500. So you've got your closing costs plus your down payment minus the deposit that you put on your contract, leaving you with an estimated cash to close of $20,264. So I hope that helps you guys understand. Now, here's another thing that I want to point out to everybody, make you aware of. If you're dealing with a lender or a bank, they're able to disguise a lot of numbers behind the scenes. You won't see things. If you're dealing with a mortgage broker, things are going to be a lot more transparent. So sometimes what will happen is you will see a charge in section A, and then you'll see a credit down here from the lender for a dollar amount offsetting that. So don't ignore that section, because if there is a lender credit there, that's money coming back to you, reducing your overall cost in that box A. Okay, so something to be aware of. Come down a little bit further here, and just to kind of give you some understanding, I want to share some things and express some information that's very important. Obviously, these numbers can look very alarming, because you're borrowing a dollar amount and you're paying it back over 30 years. So the interest that you're going to accrue in a time period is going to be very extensive. So something that I want you to be aware of is that the minute you make anything extra in a principal payment, if you pay the loan off earlier, it's going to change all of these numbers, because you're only paying interest while you have the loan outstanding on the dollar amounts that you still owe. So something that I want to talk about is the annual percentage rate. Many people have been taught that you should shop your mortgage based on the lowest annual percentage rate, but that is not a reliable number. That number is determined. They take the total monthly payments if you pay this loan 1 month at a time for the term of the loan. In this case, it's 30 years. Any fees that are incorporated, and that's your total cost, and that's your effective APR. Well, if you repaid the loan in 5 years, right, you're not going to pay anywhere near that same amount of interest. It's going to blow this number up. It's not going to match that at all. So my suggestion is ignore this and pay attention to the line items up here. This is what matters at the end of the day, as well as the interest rate to which you're accruing payment or your monthly interest on. Those are the things that make a difference for you. Those are the things that are going to be reliable numbers that you can lean into. So I hope this gives you a great understanding of closing costs, how to review a loan estimate, and we'll give you a little bit more information as we continue below. Now that you have seen what a real loan estimate looks like, let me cover the pieces that tend to surprise buyers the most, especially here in Florida. This is the section that gets buyers who have purchased in other states. Florida is different, and these charges add up fast. Florida charges a documentary stamp tax on the mortgage, 35 cents per $100 of the loan amount. On a $360,000 loan, that's $1,260 that the buyer's paying. Florida also charges an intangible tax on a new mortgage at 0.002 cents per dollar of the loan. On that same loan, that dollar amount is $720. Those two taxes together are nearly $2,000 that the buyer in most other states will never pay. Your lender cannot change them. It's state law. Now let's talk about title fees, because this one trips up a lot of Florida buyers. In most counties, the seller pays owner's title insurance, but that does not mean the buyer has zero title cost. You still owe lender's title insurance, the settlement fee, a doc prep fee on your side of the closing statement. Even when the contract says seller pays title, those buyer side charges typically run $1,000 to $1,500. And in some counties, Miami-Dade, Sarasota, and Collier, it is actually the buyer who pays for title insurance, not the seller. Always confirm the custom for your specific county before you write the offer. Your contract is ultimately going to dictate who pays. Now, let's talk about prepaids. These are not fees. They're payments you would owe anyways. They're just collected up front at closing. Your first year of homeowner's insurance is paid at closing. In Florida, this number varies a lot right now depending on the location, roof age, construction type, flood zone. You're going to get a real quote before you lock in your budget. Prorated property taxes from your closing date through the end of the tax period. In-term interest, the days from your closing date through the end of the month. Close on the 5th and you'll owe 26 days of in-term interest. Close on the 28th and you only owe 3 days of interest. On a $400,000 loan at 7%, that difference is roughly $1,800 versus $200. closing near the end of the month is real and legitimate way to reduce what you bring to the table. And an escrow account, usually 2 to 3 months of taxes and insurance to seed the account. Now, I want to end on this because it matters more than anything else I've covered today. Yes, compare lender fees. Get 2 or 3 loan estimates and look at them side by side. But before your focus is on who is cheapest, focus on who actually knows what they're doing. There are dozens of mortgage products out there: conventional, FHA, VA, USDA, bank statement, jumbo, renovation loans, and each has different costs and different long-term implications. Getting the lowest closing cost on the wrong loan is not a win. A buyer who qualifies for conventional but gets put in FHA pays mortgage insurance potentially for the life of the loan. A veteran who does not know about their VA benefit ends up with a down payment and monthly PMI, private mortgage insurance, they never needed. A self-employed buyer gets steered into a bank statement loan when they could have qualified conventionally at a better rate. Ask your loan originator, any loan originator that you talk to, what products they considered for your situation, why they landed on what they're recommending. If they cannot answer that clearly, pay attention to that. I'm Toni Taylor with Interconnect Mortgage in Palm Beach Gardens. We go through all of this before you start making offers, not the week before you close. Links are in the description to schedule a call and grab my free pre-approval checklist. No pressure, no obligation, just real numbers so nothing catches you off guard on closing day. If this helped you, hit the subscribe button. I put out real mortgage education for Florida buyers every week. See you in the next one.